What's up, team? I'm Andy Wang and welcome to Channel Clarico, where we make complex accounting things simple. In this video, we're going to be talking about companies. Specifically, what are the different ways you can pay yourself out of a company as a business owner in Australia? Now, this only applies if you run a business through a company structure, and if you're unsure what that is, check out our video on companies here. By the end of this video, you will achieve the following. Number one, clarity on the 3 common ways to pay yourself from a company. Number 2, pros and cons of each method. And number 3, when each method is used. Now, before we get into it, as always, this video is super general and it's to help you as a business owner understand this stuff better. I'd recommend to check in with your accountant before making any decisions on using any one of these methods. With that out of the way, let's get right into it. Method number 1, wages. Now, this first method of paying yourself from a company is through a wage, and it's oftentimes the most common. And when I say wage, I mean processed as a pay run, like you would pay an employee. In this method, you are treating yourself like an employee and you'll be doing the following. You'll be filing wages with the ATO, you'll be setting aside PAYG withholding, you'll be paying superannuation, paying workers' insurance, maybe paying payroll tax. Now, if you're a bit like, what does all of that mean? Check out our video on tax obligations for employers here. So, why would you pay yourself via a wage? Well, firstly, this method requires the least planning because tax is being withheld on your wages as you go along. So you're unlikely to be surprised by a huge tax bill at the end of the year. Another reason you'd pay yourself with this method is for retirement. When you pay wages in Australia, you have to pay superannuation, which is like money for your retirement. And this method prompts you to put money aside into superannuation, and this is something which a lot of business owners forget to do. Finally, paying a wage gives you a better indication of how profitable your business actually is. A wage shows up in your business as an expense. This means when you look at your profitability reports, it will reflect what you've paid yourself for your efforts. Now, this is super useful when you're a business owner who works in the business as well as on the business. So why would you not pay yourself a wage? Well, a wage comes with extra costs. Because paying a wage means you have to pay superannuation, workers' insurance, payroll tax, even if that wage is to you, the business owner. Now, you can argue that superannuation is for you, but depending on your age, that's money you might not see for a long time. And when you're starting a business, things could be tight. Another downside of paying a wage is that the receiver of the wage is the one who pays tax on those wages. Now, if you already have lots of income in your personal name from other sources, you might not want that wage to yourself because you might have to pay lots of tax on it. So who would a wage be for then? Well, I generally like paying wages when there's a minimum amount I know I want to pull out of the company. So for example, if the company is my only source of income and I know that I need like $50,000 a year to cover my personal expenses, then I might pay that out as a wage. Another scenario where I'd pay a wage is if the business owner works in the business as well as on the business. For example, if you're a clinic business owner and you work as a physio in the clinic full time, it might be a good idea to pay yourself a wage for that clinical time. Pretend you need to hire someone else to replace you as a clinician. Whatever you're going to pay them, you should be paying yourself too. Method number 2 is dividends. The second method is a dividend, and we won't go in depth on what a dividend is, but at a super basic level, a dividend is a fancy way of saying profit distributions. Now, if a company makes profits, you can pay out those profits to the shareholders, which is a fancy way to say owners, and these profits are what you call a dividend. So why would you pay out dividends? Well, the most obvious reason to pay out a dividend is if you have multiple shareholders and they all want to get some profits from the company. You would normally do this as a dividend rather than like a wage. Think about it. When you invest in shares on the stock exchange, for example, they aren't paying you wages, they're paying you a dividend. Secondly, if you recall, wages can only be paid to people, and whichever person receives the wage needs to pay tax on the wages. When it comes to a dividend, though, this has to be paid to shareholders, and the shareholders can be ranged from being a person, a family trust, or even another company. This means it could result in tax savings compared to paying a wage. Now, depending on who the shareholders are, this may differ, so the details of this gets pretty technical, so best to have a chat to your accountant about this. Now, you also might want to check out our video on companies and trusts. Check it out here for a bit more information on the different structures. Now, another reason to pay a dividend is because it doesn't come with any of the extra costs like a wage does. Now, there's no wages tax, there's no superannuation to deal with, there's no workers' insurance or payroll tax. So why would you not pay a dividend then? The first reason is that it requires planning and expertise. There are efficient and inefficient ways to pay out a dividend, and these can get pretty technical. So paying out a dividend requires planning with your accountant. Secondly, a dividend is paid out to shareholders in proportion to their shareholding, which is all well and good, but let's give an example. For example, if a company has two shareholders who each own 50% of the company, that means any dividend paid out will need to be split equally between them. This is all well and good if the agreement in place is for both shareholders to receive equal amounts. But what if one shareholder should be getting paid more because they work in the business and the other doesn't? Well, in this case, a dividend isn't suitable because whatever gets paid to one needs to be paid to another. And finally, a dividend can be paid only out of profits. If a company hasn't made any profits, it won't be able to pay a dividend. With all of that in mind then, who was a dividend for? Well, it's great if the business owner already pays a wage to themselves for their work inside the business and they want to pay profits out of the company. A dividend could also be a really tax-effective option if the shareholder is a family trust. It means there is flexibility on who ultimately pays tax on that dividend. And once again, this is very high level, so this is something you want to plan out with your accountant. Method 3 is a loan. All right, we're on the home stretch. The final method and the most controversial way to pay yourself out of a company is by a loan. And I know, I can hear you asking, Andy, what do you mean by a loan? Well, the official term is called Division 7A loan, and the specifics and what this all means is a bit too much to cover in this video, so we'll have a specific video dedicated to what this is. But what does it exactly mean to pay yourself through a loan? Well, a loan arises when a business owner takes money out of a company and it's not a wage and it's not a dividend or any other method, so they haven't formally classified it. Basically, you're taking money out of a company, and from the company's perspective, that's money you owe back to the company. So why would someone choose to pay themselves via a loan? Well, the good news, you don't have to pay tax on it in the year you draw it out. Now, don't get too excited. This is very temporary, and that's honestly it for upsides. When it comes to a loan, when it comes to the downsides of a loan, like I said earlier, you generally don't need to pay tax on this in the year you draw it out, so it can feel like a massive win. But what were those certainties in life again? Death and taxes, right? When it comes to the loan, you'll be paying taxes on it in the future, and it comes with interest. Now, this is a more complex part of the tax law, so we will have a separate video dedicated to this. But what you need to know now is in many cases, you could actually end up paying more tax using this method compared to the others. So who should use a loan? Well, this is super useful if you want to defer tax temporarily because there's a strategic advantage to do so. Really important to note, only use this method if you're planning it very carefully with your accountant. Otherwise, I generally tell people to steer well clear because, like I said, you're going to be paying tax sooner or later, and oftentimes it's with interest. As you can see, the loan method comes with downsides and it needs to be used with care. What I find though is that Many business owners actually accidentally fall into the category of using the loan method without understanding the downsides. What ends up happening is that the business owners draw money out as a loan year on year because they don't need to pay tax on it straight away, but all they're really doing is kicking the can down the road. Imagine going out to the bank and taking a loan out year on year on year. At some point, the interest and repayments start to add up. Like I said, handle with care. If you have been using the loan method, ask your accountant on what your strategy is to minimize these loans moving forward. All right, team, that was how to pay yourself out of a company. To sum things up, the most straightforward way to pay yourself is using a wage. A dividend can give you some awesome flexibility depending on how you're structured, and a loan needs to be used with extreme care. One thing to note though, the different methods don't have to be used mutually exclusively. For example, you might choose to pay yourself a commercial wage for the work you do in the business as an employee, and pay yourself a dividend for any profits you want to take on top of that wage. Have a chat to your accountant to see which method is right for you and to come up with a strategy that is customized to you. On that note, peace.